Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go, generally related to three different topics: wealth building, commodities, and or financial topics. So we're going to dive right into it and see what people are sharing. If you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com, where we have question and answer sessions on the weekends. We've got midweek updates of what's going on technically. And I do look for potential investment opportunities in the market. Those investment opportunities cycle depending on where we're at in the cycle. So sometimes energy is a good time to purchase, sometimes gold or precious metals and mining companies, and other times it might be other sectors, perhaps emerging markets is low or something like that. So looking at gold predictors, he says gold, big picture view, is continuing gold rally in quarter three and quarter four of 2024. There's your shoulder, head, shoulder, or a cup and a handle pattern. Either way, it doesn't really matter. You're breaking the trend line right here, which is could be considered a neckline, could be considered the cup and handle top. And the projection of that breakout would be the size of this move from here to here, projected upward. So we do have quite a bit of ways to go to continue higher for gold. Another thing to look at is when does gold go up? Not just does this pattern tell me it's going up. Gold goes up when the yield curve uninverts, when yields drop, and the short end of the curve drops more than the long end. Do we have that ahead of us? Very much a possibility where we could get an uninversion of the yield curve. We can also see that gold goes up when unemployment goes up, and we are seeing unemployment go up. So you could say gold is further evidence. Gold going up is further evidence of the unemployment rate going up, which is further evidence of the yield curve uninverting, which is further evidence of a potential slowdown recession that is coming. And that all of these things create an opinion by the market by these patterns. And that's how I view the markets. I just described exactly how I view markets. I look for evidence across many different things, gold being one of them. We can also see that silver has broken out to the upside, which is further evidence because gold and silver run together and they do very well during certain periods during the cycle. And I think that's just describing where we're at in that cycle. BTC post-halving bullish rally is pending, and that's what a lot of these guys in Bitcoin, they are bullish, 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 bullish. And it says some more consolidation correction, and then we go up from here. But here's the thing: when this has gone up, we had 2017 to 2018, and then it had to decline from 2018, 2019, and it consolidated all the way to 2020. Then we basically hit the consolidation phase. Not reconsolidation, reliquefaction phase, where they liquefied stimulus, bring down interest rates, all those things. Gold did well from here to here. Then gold did very well with Bitcoin, this price move up when that stimulus went into the system. It accounted for that new money creation. It did that in 2008 and 9 as well, all the way to 2011. Gold did. So did Bitcoin here. So Bitcoin is a liquidity measuring stick for the most part. I don't know if this is going to occur the way that they're going to have it unless they print some money here, unless they get stimulus into the system or something like that. I could easily see Bitcoin going up with more liquidity coming into the system. Another thing that might push Bitcoin higher is what about if the liquidity doesn't come from the United States but comes from China and other places around the world? We are very US centric and based on what the United States is doing, but there is also other countries that may add liquidity into the system that we might not be looking at. And I think China could easily add a bunch of liquidity, which may have an impact on Bitcoin going up. Michael Saylor says 4 years ago today, MicroStrategy adopted Bitcoin as its primary treasury reserve asset. Since then, MSTR has outperformed 499 of 500 stocks in the S&P 500. Now, here's the thing that I'll say about that. Bitcoin was created at the beginning of a recovery phase of real estate in 19 or not 19 2009. That's when people started catching on to it. 2009, 10, 11, 12, like all through there. We've been in one market condition that Bitcoin has been subjected to, and technology has gone up the entire time. It was basing out in '09, 2010, 2011, and then it broke out 2011 and onward. I would be very curious to see what happens if we see a big change where hard assets outperform technology and technology goes down 80, 90% from high valuations that they're at. What does that do to MicroStrategy's balance sheet? What does that do to Bitcoin itself? And can Bitcoin survive a different market condition, which it's never gone through? Now, some people will say, well, it's gone through cycles, only with the tailwinds behind it. When the headwinds come, I'm going to be curious to see if it can even survive it. Or it goes to some event where maybe the fees, because remember, these things continually have, and it becomes more expensive to mine. What happens when the mining fees are more expensive than the Bitcoin price itself? So what if Bitcoin's 10,000, but the fee to transact is like $5,000 or $10,000? What happens then? Does the price freeze? What occurs? And could Bitcoin go to like $1,000? Or maybe it doesn't transact at all and the price gets frozen because the fees are so astronomical that Bitcoin must continue higher in order for it to survive by design of the system. I don't know. Here's China liquidity. I was talking about Chinese liquidity. He says, in his opinion, China liquidity is about to explode. Hope you know what that means for Bitcoin. And this is People Bank of China liquidity injections, and we're coming into a cycle here where down cycle, up, down, up. We're coming into an up cycle where we're going to get a bunch of liquidity into the system. Now, here's one thing that I don't think a lot of people keep in mind here is stimulus comes into the system. It may or may not work. And the demographic of China is they're not in home buying years. There's a huge drop off. I don't know if stimulus is going to be impactful with a demographic that looks like that. Think of Japan's demographic and all of the stimulus that they have done. And a lot of that was not very, it didn't transpire into inflation. So that's what I'll say there. They just don't have the demographic to keep driving the real estate market up. And that's credit that gets into the system is from credit creation from the monetary side. Here is uranium. So it says once we rotate from US mega cap stocks into gold, silver, copper, and other commodities, funds and famous investors won't talk their book till they filled up. So remain cool headed, knowing the Fed is once again behind the curve and cutting. It's bullish for hard assets as in '02 to 2011. '02 is when we had that big decline in the dollar, which started right here in this general area. I think we are very similar to that, and we could see a big move in commodities with the dollar dropping if and when they lower interest rates. This is the commodity to financial asset ratio is what I'll call it. Equities is financial assets, and we're at a very low level. We are at a lower level than we were in the beginning of the 2000 commodity boom. This is where I think when this goes up, you could see dramatic increases in commodity equities. What is dramatic? It's not 1 or 2x. It could be 10x, 20x, 30x, 40x, 50x, 100x, depending on the company, depending on if the company is in stride. Sometimes some of these companies are coming into stride. They're going to produce a lot more, increases of production of 100, 200, 300% during a commodity boom equals gains that you've probably never seen before. The important part is to get in early and hold on for that commodity bull market. All of these commodity bull markets occurred under expansionary phases of real estate. They've all peaked during certain areas using inventory, is what I'll say. I won't disclose the exact information there. Here's correlation economics. We know palladium is a short, but we're not safe in platinum either. Smart money is exiting. I don't think so. I think that this is a basing period and we will break at some point. Now, that doesn't mean in the short term that if we do get a slowdown, it will negatively impact platinum. But platinum and palladium are both at their cost curves. In fact, they are below the cost curves. And the companies that produce over 70% of the world's platinum and palladium, I'll just say platinum group metals, has already cut production, has already laid off people, and has already shrunk supply. So the supply is already shrinking. There is a large deficit in platinum coming. The macro might overpower the fundamentals of the platinum sector in the short term. That is a huge buying opportunity if that occurs. But right now, we're underneath the cost curves. They've already cut back production. It's just a matter of time, in my opinion. And right now, we're riding on the cost curve. It's the lowest risk time to buy something is when you can buy it below the cost curve. Now, does that mean it can't go lower? No, it can still go lower in a macro-driven event where everybody sells everything. But that's an opportunity. And if you know what the cost curves are, if you know they cut back production, if you know there's deficits of 1 million ounces or so in platinum, then you're ready. You're locked and loaded. You know what to do. Here's Gary. He says, ask yourself this question, and this is for NVIDIA if you guys want to know the stock. Do you really think this is over with the poster child for mindless leverage speculation still stretched this far above the long-term mean? And this is your long-term kind of going on up. You can see how far we've stretched above that. A lot of the times it snaps back to this average. It could be a 200-day or 50-day. It doesn't matter what moving average you use. But a lot of the times, whenever you get overextended like this, you get a large snapback. And it's usually a bubble. Patrick Karam says, same exercise can be done to establish endgame targets for gold and crude oil. Can you guess what those targets are? I'll give you a clue. Much higher. And I agree. I think gold, precious metals in general, and crude oil. What he's got here is good morning, everybody. $170 target for silver. Read below and see how it's possible. I'm not going to go through it, but I want to focus on this chart he's got. I like the chart. This is SPX versus silver, and what we're charting are market conditions. The market conditions in the early 1900s, and then the breakdown in 1930, 29.30, 31 here. Silver was 29 cents in 31. We had another breakdown here in 1973 of silver breaking lower. We had another major breakdown in 2001, and then another major breakdown that's about to occur. I think this breakdown is telling us the market conditions that is coming. And when silver outperforms the SPX, it's telling us we're in a commodity bull market. And right now, if this breaks here at any second, we're going to start that commodity bull market. What's going to start it? I think technology stocks will roll over. I think the S&P 500 will go down originally. Like it'll originally break through. It'll go down. Silver does well and gold under a yield curve that uninverts. And that's exactly what starts this whole thing, the uninversion of the yield curve. The dollar will go down probably for a period of time, and this will break lower. And if it breaks lower, he's got a couple of things. Silver can be $1,580. Silver can be $170. It really depends on what the SPX is valued at, because the S&P 500 will go down and silver will go up. And this is what he's got. He's got a sideways action for about 10 years. Completely agree with that. Completely and utterly agree with that. The commodity bull market's coming. We know that commodities are cheap to equities, and all of this is turning. It just takes time, guys. It takes some time. David Murrin says the next commodity surge has commenced. We believe that the commodity sector is now at the start of one of its biggest rallies in 56 years, with an expected peak in 2025 to 2027, as recently explained. So that's what his opinion is. of what's coming. And I agree with that opinion there. Dips in the S&P 500 often lead to returns that exceed the initial drawdown. So you can see all these dips that they had historically since mid 2015, and then the returns and performance over the next 6 months after those dips. So whenever you get a big dip, that's generally a good time to buy in whatever you're looking at. This is the S&P 500 and what he's using. Here's silver, GSR, bottoming on silver, and this is your breakout and return move. And I do think we're going to be bottoming here in silver soon, and we're going to get a big breakout. Big breakout here, guys. This is big. It's going to run like Forrest Gump. URNM, Sprott Uranium Miners ETF, backtesting the 2020 uptrend line. Risk-reward ratio not skewed to the upside, zero emotional bias, and he's just showing that we're hitting that uptrend line. I did notice that some of the comments in this, line drawn, meant to be broken, take your uranium stocks to the backyard shed and shoot it in the head. We got a lot of people, uranium miners where the money goes to die, like gold miners, but worse. A lot of people are pretty negative on the sector, is what I'll say. Here's Microsoft, bellwether stock, ominous setup, very concerning. And I know that he is very bearish on everything, but it is a possibility, is what I'll say. That does look pretty bearish. Gary Savage again says, in my previous post, I noted there are bear flags everywhere. Those should break down this week and we get a test of recent lows. The SPX might get a full retest or full test of the 200-day moving average, maybe a drop to 5,000. After that, we should get a very convincing bounce into the end of August, a bounce that will draw most everyone back in thinking the selling is over. It won't be over. The rally will top and roll over without making new highs, then all hell will break loose in September and October. So he thinks that we are in a topping region, that it's a bull trap going into the end of August. And I could easily see that and definitely think that that could be a possibility. I do. And then the yield curve would invert, unemployment goes up. It all makes sense. It does. North Star with Bitcoin needs a huge rally today to avoid a very bearish signal. And what he's got is a couple of resistance lines, a top resistance line, a bottom resistance line, and we've broken through that. Failure to hold above the rising support level, and we're coming up against resistance zone. Are we going to break higher? Are we going to break lower? Now, this doesn't look very good when you've got a 2-week TSI cross signal going lower. It looks like we want to break to the downside. What originally this kind of measures are these large impulse moves lower, and that's the momentum rolling over. So the TSI bearish cross doesn't mean a new all-time, a new ATC isn't possible, but it does give some cause for concern. Following a 2-week TSI cross, we've never exceeded previous highs by any more than a few percent. So yeah, it is looking a little bit weaker. It's one to watch. CCJ, I don't see Cameco below that support line, below $35. This is a gift in his opinion. Now, what I'll say is if the overall markets roll over, I don't think Cameco is going to defy and just rip. I think we could see commodities all pull back for a short period of time. If there's a liquidity selling type event where everybody kind of sells everything, then we rip. It's going to be a slingshot. So everyone's going to they're all going to move to the wrong side of the boat, and then it's going to slingshot back to the other way, and people are going to be trying to chase their way back into equities for commodities. How long it will take, I'm not sure, but I think that will be the case. U.S. banks are facing $517 billion of unrealized losses. Nobody wants interest rate cuts more than them. And these are their losses here on the right, or unrealized gains or losses on investment securities. And there could be a banking problem because of this. There could be. If they get on the wrong side of anything and they lose a little bit of money, they've already are down so much, and their liquidity could be tested. Mike Zaccardi says energy sector weightings as the percent of the S&P 500 index, 29% in 1980. 1980 is when we had very high interest rates. 4% today, very, very low. I think we bottomed at 2% during the COVID crisis, and the dot-com bubble, we were at 5%. That looked familiar, guys. 5% dot-com bubble. We had 2% COVID crisis, and we have another 4%. 4% is where we're at today, and the tech stocks are way up there. So this is all signaling that we could potentially move on up, probably greater than 15% is my guess, in one of these run up, where the energy sector is going to take market share of the S&P 500. Investment wisdom: all intelligent investing is value investing, acquiring more than you are paying for, says Charlie Munger. Here's TLT, and I already went over that one last time. So we're going to end it there, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you're interested. Mayday coupon code is still active. Still have that one active. You can get 50% off the first month to try it. It's only good for the first month. Or you get a larger discount on the yearly membership. And if you're in the monthly membership, you can always move into a yearly membership and get that discount if you want to stay with me longer. So, or stay within the community is what I'll say. But that's what I've got for today, guys. And we'll catch you later. This is Finding Value.